Hi there, Francois. Yes, we're going to start with the fears that emerging markets are facing a slowdown. Worries of slowing growth in China and elsewhere have hit emerging market currencies hard. The Russian ruble, for instance, has been at a low against the euro this Wednesday. But the Turkish and South African central banks have now taken emergency action to stop the plunge. Both have come out to raise interest rates. In the case of the South African central bank, it was the first hike since 2008. As you can see right here on this graphic. It also follows moves by Brazil's and India's central bank to shore up their currencies. Let's take a closer look then at Turkey in particular. The central bank there hiked interest rates after an emergency meeting late Tuesday. It flies in the face of the Turkish government, which fears that higher interest rates will lead to slower growth. Delano de Souza has more.
Stunning investors by doubling key interest rates. Turkey's central bank increased its overnight lending rate to 12%, its overnight borrowing rate to 8%, and the crucial one-week repo rate to 10%. The move provided a boost to the lira after record lows against the dollar.
To some degree, I think in the short run there'll be plenty of relief. They do look to have removed a lot of the downward pressure. Markets now know that emerging market currencies are no longer a one-way bet.
Until now, the bank held off increasing rates under pressure from Turkey's government, eager not to stall growth. Turkey's prime minister issued a warning to the bank, saying they would be responsible for any slowdown in economic growth. While the bank's decision sent the dollar weakening against the lira, at home, ordinary citizens weren't convinced.
There is a struggle among the institutions, and prices are going up. When you look at ordinary people, their lives are miserable.
The government says they can't intervene, but that's harmful. I think it will have negative consequences on the government.
Analysts say the central bank's latest actions have helped restore its international credibility. It will have to wait longer to see whether its gamble pays off at home as well.
And next to a story that's connected to the concerns over emerging markets and a slowdown in emerging markets growth. Ben Bernanke is wrapping up his last meeting as the chairman of the Federal Reserve. It's expected that the Fed will reduce its stimulus of the U.S. economy as it did last month. This as there are signs that the U.S. economy is recovering and no longer needs the training wheels provided by the Fed. It sparked concerns in emerging markets, though, as the fear is that it will make investors move money back from emerging markets to the United States. We're going to look closely at what comes out of that Fed meeting in Washington, D.C., of course, later on this evening. Now, consumers in Germany, they're feeling more and more upbeat about the future. Research firm GfK says its reading of consumer confidence has hit a 6-year high in Germany. That's another sign that the German economy has started the year on a strong footing. A reading earlier this week put business sentiment near a 3-year high. It comes as jobless levels are stable and interest rates, they are low. Now, in a speech to Parliament in Berlin, Chancellor Angela Merkel hailed Germany's strong economy earlier, but she also said that Germany's fortunes are closely linked to those of the Eurozone and that the Eurozone debt crisis is far from over. She called for tighter coordination of economic policies among the 18 countries that use the single currency. Let's listen in.
I must point out that even though the European debt crisis isn't dominating our daily headlines, we must face the fact that it's only under control. It's far from being resolved in an efficient, sustainable way.
Dauerhaft und nachhaltig überwunden ist sie damit noch nicht.
OK, a clear warning there from Angela Merkel. We're going to bring you up to date with the stock markets next. American stocks, they're falling back this hour. It comes on concern that the moves by the Turkish and the South African central bank simply won't be enough to stem the flow out of emerging markets. We're seeing a similar picture in Europe, or we saw a similar picture in Europe at the close, where the FTSE fell to a 6-week low, with other indices also losing steam. The Paris CAC 40 down 0.7%. And once again, it is fears about emerging markets really weighing on shares globally. We're going to take a look at a few other corporate stories making waves. Shares in Mulberry tumbled almost 28% on Wednesday. It follows a warning from the British handbag maker that its full-year profit will be substantially lower than expectations. Mulberry says sales over Christmas slipped as rivals discounted their bags heavily. Shares in British retailer Sainsbury also lost steam in London. It follows the announcement that its chief executive, Justin King, is leaving after a decade at the helm. King is seen to have overhauled Sainsbury. Under his watch, sales they've grown by 60% and earnings have nearly tripled. And last but not least, Fiat is changing name after finalizing its takeover of Chrysler. The new group will be known as Fiat Chrysler Automobiles, and its shares will be listed in New York as well as Milan. The legal headquarters of the group will be in the Netherlands, and it will be a British tax resident. In Italy, there are concerns that the company is becoming less Italian, but Fiat says that the Italian headcount will stay the same. I'm going to be back with more business news later on. First, though, back to you, Francois.
All right, many thanks for that. Marcus Carlson with all the day's business news. In sports, bit of a breaking story. Let's say hello to